Intraday trading is defined by rapid fluctuations. Prices move in cycles of expansion and contraction, creating a constant pressure to react to every tick. For many traders, the difficulty is not technical. They can identify high-quality chart setups with precision, yet they struggle to turn those entries into realized profit. This friction is usually caused by focusing on the account balance rather than the chart. When a trader exits because their unrealized profit fluctuates, rather than because the technical reason for the trade has ended, they are P&L watching. The cost of this habit is significant. An early exit to avoid a minor drawdown often precedes a massive, uninterrupted upward run. The distance between that exit and the eventual peak represents the profit potential sacrificed to emotional comfort. To capture these moves, discretionary decisions based on localized fear must be replaced by a framework that dictates every action. This system is built on 3 distinct phases: validating the chart's location, identifying a specific trigger, and executing a mechanical management plan. The market does not prioritize a trader's individual risk tolerance. Success requires following a rigid rule set that prioritizes the structural integrity of the trend over the fluctuations of an account balance. Candlestick patterns are only as valid as the space they occupy. Their meaning changes depending on where they appear relative to established moving averages. This environment is governed by 3 specific lines. We use a 200-period moving average for the macro trend, a 20-period guardrail, and an 8-period momentum tracker. When the 200-period average levels horizontally, it creates a stability zone. We identify the area directly above this flat 200 as a high-probability starting point. Location is not just physical, it is also temporal. The trading day's first minutes contain uncoordinated volatility. To account for this, we use the Fab 4 rule. We isolate the first 4 bars of the day with an exclusion box and wait for the volatility to settle. Skipping these bars allows institutions to establish their initial positions. It gives the moving averages time to align into a clear direction, reducing the chance of being caught in a false breakout. Waiting for the Fab 4 to pass ensures we are entering the market only when the structural environment has transitioned into a steady trend. With the environment validated, we look for a specific ignition event, a clear signal that momentum is entering the asset. The primary signal is the elephant bar. This is a single candlestick that is significantly larger than any of the 10 bars immediately preceding it. A bar of this magnitude requires a concentrated volume of buy orders that retail traders alone cannot generate. This size indicates that institutional actors are aggressively committing capital, fundamentally shifting the balance of power in favor of the buyers. Another ignition event is the 180 reversal. This occurs when a strong red candle is immediately erased by a green candle of equal or greater size. This sequence traps traders who were betting on a move lower. As they exit their losing positions, their selling must be covered by buying, which accelerates the momentum in the opposite direction. If a trend is already moving, we look for a color change. We enter when a new green bar takes out the high of a previous red pullback candle. These specific events, elephant bars, 180s, and color changes, serve as the only objective triggers for entry. Managing an open position often presents more psychological friction than the entry itself. To counteract this, we use a mechanical trailing system. Every trade begins with a hard stop. If we enter on an elephant bar, the stop loss is placed immediately beneath its base. The base of that bar represents the point where the institutional move began. If the price falls below it, the technical reason for the trade is gone, and we exit immediately. Once the price begins to move in our favor, we transition to the 2-bar stop rule, using the 8-period moving average as our primary guide. This rule requires price action to prove the trend has ended. If a single candle closes below the 8-period average, the system mandates a hold. We only exit when 2 consecutive candles close entirely below the moving average, confirming that short-term momentum has officially shifted. This 2-bar buffer provides the asset enough room to oscillate without triggering a premature exit. It replaces the urge to sell out of fear with a systematic requirement for structural proof. By combining these rules, we can capture the largest moves available in the market, the macro trends that build over several hours. At the open, erratic price action triggers the Fab 4 rule. We wait. Once the exclusion zone ends, the 200 average flattens. Shorter-term averages slope up, confirming trend direction. An elephant bar prints off the flat 200. We enter, setting a stop at the base. The price begins to climb, and our position moves into profit. Midway through the move, the asset pulls back sharply. A red tail bar spikes down. A trader watching their P&L would likely exit here to protect their gains. Since the bar didn't close below the 8-period average, our system keeps us in the trade. We ignore temporary account dips and trust the structure. This discipline is rewarded as the price bounces off the line and launches higher, extending the trend for hours. Eventually, the momentum breaks. 2 consecutive bars close below the 8-period average. We exit the trade, securing a profit significantly larger than if we had exited at the first sign of trouble. Professional trading is the consistent application of objective rules. By focusing on the structural components of price action, you remove the emotional burden of the trade and let the system execute the work.